Hi everyone. I would like to explain further the drill investment methodology in this video session. The methodology includes our investment philosophy, which have our 7 beliefs and 8 principles. And then we have the dynamic investment management part that comprises of asset allocation, asset liability matching, investment review, portfolio management, and asset analysis. So we would also use this video to tell you how to apply in real-life situation to estimate your financial independence duration, and subsequently it helps you to determine your retirement age and appropriate asset allocation tactics. So there are 7 beliefs. In simple words, take the risk that you can take. There's no rush way to fortune. You need time to build and plan and high quality outcome from very deep work. Do not get into the herd instinct. Always think twice before you act. And we all need good health and bright mind. These have to bear in your mind. And there are 8 principles that you will use when you select your investment targets. First is know what you are investing in, know how to value the assets, and invest within your risk tolerance and limit, and do not underestimate human stupidity. Have limitation on both people and company always, and rationalize the profitability. Always maintain good diversifications and discipline in self-reflect and review. Okay, now we know there are 7 beliefs and 8 principles in the investment philosophy. We bear this in mind on the beliefs and apply the principle while we're selecting the investment targets. And now we are going to the asset allocation process. We will use individual asset absolute loss limit to an individual. Use these numbers to optimize the asset allocation decision. It is part of the dynamic investment management. So as I said, asset allocation, we use absolute loss limit to optimize. And then get into the details is you should list out your gross asset values and gross cash inflow of the year. Then compare with your gross financial burden and the gross cash outflow of the year. After these cross deductions, then we will get the net asset value and net cash flow. Okay, let's see the example in more details. Look at the table and get both positive number. If the net asset value and the net cash flow are negative, one should redo the asset allocation with new absolute loss limit and yield assumptions. Even the numbers are all positive, but you are not satisfied, we should also redo the exercise again. So this is so-called the dynamic investment management process. Okay, so the asset liability matching process that we have just described enable you to find out the net asset value and net cash flow. After that, you still need to have a disciplined investment review process. You have to review it at least every 3 months, the investment assumptions, examine the profit and loss, the risk tolerance limits, and the outlook of the asset class. If you have the new numbers applied into your situation, see whether you need any adjustment. If you cannot sleep well, definitely you need to immediately review your asset allocation and the extent of your risk tolerance. If you have health, you have risk capital, there are always investment opportunities available for you. No need to rush. So we should all embrace the personal aggregate wealth concept that we need good physical and mental health. So remember, when we do the dynamic investment management part, the discipline review process is closely knitted with the portfolio management, with the asset analysis part. Okay, now I would like to explain a bit how to use our dynamic process to calculate your financial independence duration so that you can project your retirement age, how many years you still need to work, and then change the corresponding asset allocation tactics and allocations. We still use the same example, the same numbers, so you need to spend some time look at the details of the numbers. So we have several assumptions to make the case very simple, so you can add the complexity yourself. First, we assume full repayment of the mortgage after 10 years, in 10 years scenario, after 20 years, in 20 years scenario. We assume after that, after you stop working and no mortgage, you no need to pay tax. And we will assume all the yields and the burden will not grow and keep it at the same time as is now. So remember, there are no salary income after 10 or 20 years scenario. So we got the number. After you stop working, you have a negative cash flow value, obviously, but you have the net asset value. This is positive. It's mainly coming from your property, that like most of us. Okay, now we have the result of the estimations. We use the last assumptions that we have described in last slide. We use the same asset profile, assuming the person is now 40 years old. If stop working after 10 years, is 50 years old, the financial independence can last for 27 years. That means at 77 years old, the person can still use reverse mortgage for their daily expense. If the person stopped working after 20 years, that means stop working at 60 years old, the financial independence can last for another 33 years. That means at the age of 93, the person can still use reverse mortgage for daily expense. So this is a simple exercise with a lot of assumptions to simplify the situation. Of course, you can have a lot of complexity adding during the 10 years and 20 years scenario with different assumptions. The example is to illustrate how to use it dynamically. And another person asked me, if now I'm very risk averse in this very chaotic situation, what one can do? They can reduce their risk exposure and focus on cash, short-term bonds, and residential properties. Wait until investment conviction are back, and then they can add back the risk assets. But take note, lower risk allocation means lower return, and it should reduce the number of years of financial independence. So welcome, any question can email me. And just to recap, our dual investment methodology complies of our investment philosophy and our dynamic investment management part. And we have just illustrated how to use dynamically to calculate your financial independence years, and subsequently can help you determine your retirement age and the correspondingly appropriate asset allocation tactics and strategies. Thank you so much for your patience. See you next time. Thank you.